audit engagements under US GAAP, IFRS, and Indian GAAP. So I'm very happy to invite Anand over here. And it's a first virtual meet for the group. And over to you, Anand.
Thanks, Nishant, for the introduction. Good evening, everyone. Thank you for joining this session. So, today's topic is going to be purchase price allocation. Now, I want to make this session as interactive as possible. So while, we can have questions towards the end, but, if at all you guys have any inputs or want to share any experience on a particular concept that we are talking about, just feel free to kind of maybe raise your hand and, we can pick it up at that moment itself, so that those concepts, with the help of your input and my input can help the entire group in real time. So, as the name purchase price allocation suggests, it's essentially an exercise that allocates the amount that is being paid, or that has been paid to acquire a business into various assets and rather tangible and intangible assets that have been acquired in the course of a transaction. Now, the purchase price allocation exercise is governed by Ind AS 103, which talks about business combinations. And through this presentation, what we'll do is, we'll kind of discuss certain concepts and requirements under this standard, and obviously, we'll keep discussing your inputs as well. So Ind AS 103 essentially applies for any transaction or an event that meets the definition of a business combination. However, any kind of joint ventures or an asset acquisition, or if it's a transaction between entities under common control, then those are essentially scope exceptions to Ind AS 103. That means the PPA, or purchase price allocation, does not apply to such transactions. So 103 lays down, principles and requirements for recognition and measurement of the identifiable assets acquired, liabilities that has been taken over, and any non-controlling interest. Apart from that, it also talks about principles for recognition and measurement of goodwill or gain from bargain purchase, and discusses the disclosure requirements. So now, what exactly is a business combination? So business combination is a transaction or an event in which an acquirer obtains control of one or more businesses. Now, what we need to stress on over here is going to be control and businesses. Control, as the name suggests, again, is the power to govern certain policies of an entity so as to obtain benefits from its activities. Now, this is a definition, but by the meaning of the word control means you have the right to control the activities of a business. You have the right to make certain strategic financial decisions in a business. That's when you're said to have control. Now, this control may not be financial control. You may not be having more than 50% ownership, but if you have a high number of board seats for whatever reasons, you still are said to have control. The second important word you need to take care of here is business. Now, what exactly is a business, right? So again, by definition, it gets a little complicated. It's an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return in form of dividends, lower costs, or other economic benefits. However, just to simplify it, it's essentially a combination of three units. So one is an input, second process, and output. So input are basically any resources that has an ability to create output when one or more processes are applied to it. Process is any system, standard, protocol, convention, or a rule that when applied to an input can create or creates any outputs. An output is basically a result of inputs and processes applied to those inputs that provide or have the ability to provide a return directly to investors or other owners. So now what it says is that, if you're acquiring, let's say, certain assets, right? And if those assets either is an input or a process, or it's both of them together, they kind of obviously help you to create an output. And if an output is a result of the acquired assets, it essentially means that you've acquired a business. Now, let's kind of simplify it further, right? Let's look at it this way. So this is a chart that we generally use to determine whether what has been a part of the acquisition, does that really fit into the definition of a business, and should you apply Ind AS 103 on that? So one is, let's determine what did the acquirer buy. In that process, did the acquirer kind of acquire any existing processes to be able to produce an output? If the answer is no, were there certain processes which automatically kind of got themselves attached to an input? If that's also no, that means no, you've not purchased a business, you've just purchased an asset. Going back on the left hand side, so are there enough sufficient inputs and processes that form a part of what you acquired? If yes, it's clearly a business. If it's no, this is where it gets interesting. If it's no, are certain processes or inputs which are missing to be able to create an output? Okay, can those inputs or processes be easily added by any market participant or anybody else acquiring the assets in the market? Could they probably just add certain inputs or certain processes and create an output? If the answer is yes, it's a business purchase. If no, it's an asset purchase. I've down over your table. You guys want to have a quick take on, what do you think one of these assets that get acquired would they be classified as a business purchase or an asset purchase? I mean, you can maybe just type down something on the chat box or unmute yourself. Okay, great. Right. So Akshat, intangible asset by itself may not be a business, because think about it.
I kind of agree. I was going to write it's not exactly a business, but probably not an asset also.
It can be. So say for example, if I'm just transferring a trade name.
Correct. Yes. Then some intangible could be an asset, but not all intangible could be an asset, is what
Absolutely. I agree. Yeah. Okay. So I think machinery, I think everyone agreed it's an asset. Intangible, most likely an asset, but yes, it can, depending on the nature of intangible. I think I put in a wrong example. Trade name by itself should be an asset. So a plant, okay, when I say plant, I'm trying to say a particular, let's say a factory in a particular location, right? That essentially would be a business, because you're not only acquiring those assets, there are obviously certain processes in place which any other acquirer could just source raw material and generate an output from that business, right? So the plant kind of becomes a business. A product division is also a business. I think, yes, most of you all have said that. And the workforce by itself cannot be a business. It is an asset, because the workforce has specific expertise, which if added with a specific process would lead to actually be a business purchase. Okay. So moving on, and to basically, so Ind AS 103 talks about using the acquisition method of accounting for the purpose of a business combination. Now there are 4 steps involved in the acquisition method. One is identifying the acquirer. Next, determining the acquisition date. Third, recognizing and measuring the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiring. And finally, recognizing and measuring goodwill or gain from bargain purchase. So let's go through these one by one. First is identifying the acquirer. So obviously it's very important for us to know who the acquirer is, because that's the entity which will have to actually carry out the purchase price allocation exercise. So obviously the entity transferring the cash or assets, or who incurs the liabilities, is an acquirer. In case there are exchange of equity interests, obviously the person who has control, so the one who has the largest portion of voting rights in the combined entity, and or the largest in terms of size, And if at all it's a business combination involving two or more entities, or there are times there's a third entity which is acquired or which kind of gets formed. In that case, that will be the accounting acquirer in this case. Step 2 is determining the acquisition date. This is very, very critical because as we are all aware, valuations are always as on a particular date. They can completely turn around if the date is different. So making sure at the start of an exercise we are well aware of what the valuation date will be, which should be in our case the acquisition date. An acquisition date is essentially the date on which the acquirer obtains control of the acquiree. Now, what do you mean obtain control? So there are three things that need to happen. One is there's a legal transfer of the consideration. Second is the acquirer actually has control on those assets and assumes all the liabilities of the acquiree. Step 3 is recognizing and measuring the identifiable assets acquired, liabilities assumed, and non-controlling interest. So here, we have to be mindful of the recognition principle. So all identifiable assets, liabilities, and non-controlling interest shall be recognized as on the acquisition date, subject to the conditions. It must meet the definition of assets and liabilities as per the framework issued by ICAI. And those assets and liabilities need to be exchanged a part of that particular transaction and not a separate transaction. So, if there is one SPA that you guys are looking at and it excludes certain assets, which probably are told that, they already formed a part of a separate transaction, you can't really kind of club it together for the purpose of this exercise. One thing we need to be mindful of is there can be certain assets and liabilities which were never recognized by the target. Those can also be recognized now when you're preparing the purchase price allocation workings, obviously subject to those assets and liabilities meeting the framework above. In terms of measurement, now these identifiable assets acquired and the liabilities assumed have to be recorded at their fair values. We'll kind of discuss this at length, but by definition, it is an amount for which an asset could be exchanged or liability settled between knowledgeable, willing parties at an arm's length. And also, we need to ensure that any non-controlling interest, or say, for example, if you've not acquired 100% of a company, if there is some non-controlling interest, that non-controlling interest also needs to be recorded either at fair value or at the non-controlling interest proportionate share of the acquirer's identifiable net assets. So we'll discuss each of this as we go ahead. So as we saw, we spoke about the first three steps. The fourth step now is basically recognizing and measuring goodwill or gain from a bargain purchase. Now, how do you recognize goodwill or a gain from a bargain purchase? Again, simple mathematical formula. It's the consideration transferred, basically that means the amount that was actually paid, plus any kind of or plus the fair value of non-controlling interest, plus fair value of any previous stake that was held by the acquirer in the target, less any kind of assets and liabilities assumed which have been separately recognized. And the balancing number will either be goodwill if it's positive, and if it's a negative number, that is if my consideration is lower than the net consideration is lower than the net assets acquired, then it means it's a bargain purchase. The first point here was measuring and recognizing the consideration transfer. Now, what do you mean by consideration transfer? It's essentially any kind of assets that were paid to acquire the company. So it could be cash, it could be some other asset on your books in case of a non-cash asset. It could be your own shares. It could also be any kind of liabilities that I have assumed, which I will be paying off to the erstwhile owners. And it also includes any kind of contingent consideration. Now, contingent consideration is something that is required to be measured at fair value. And contingent consideration essentially means that there are any additional payments that are contingent on a future event. Now, there can be several examples of a future event, right? It can simply be passage of time. You can say that we'll transfer around 10 crores post 6 months. In that case, it's a pretty straightforward exercise. We'll just present value the 10 crores and add it to your purchase consideration. It could also be in the form of certain milestones. So maybe if the company reaches a revenue of X at the end of year one, an additional consideration of why would be discharged? It can be linked to revenue, it can be linked to EBITDA, it can be linked to any other factor, financial or a non-financial parameter. What is important here is that we need to know that such a contingent consideration needs to be fair valued. It again can be either a liability or equity. It can be classified as a liability or an equity. When you say it's when a consideration or a contingent consideration is to be settled in cash at a future date, it's essentially a liability. If contingent consideration is settled by way of issue of any equity shares, then it's classified as an equity. Now, when it's a liability, such contingent consideration needs to be fair valued at every reporting date. So, say for example, it said that if the revenue of the company at the end of 2 years breaches $1 million, then we'll discharge another $100,000 of consideration. So at the end of year one, we need to again fair value what we had recorded at the time of acquisition to kind of true up or reduce the amount based on the possibility of the target being achieved. However, if it's classified as an equity, then there is no revaluation required on every reporting date. One of the most common contingent consideration that you guys have seen is something that is paid to the erstwhile owners, and they want them to kind of continue for a couple of years just to ensure those continuity and a smooth handover of the business to the acquirer. In that case, a lot of times you see that a payout is linked to that particular employee or the particular owner continuing in the business. Now, accounting standards are very, very clear about this. If at all there is any payment that is linked to continuous employment, that is not contingent consideration. It cannot form part of the purchase consideration. And such payments, as and when made, will be recorded in the profit and loss account of the post-acquisition entity. So, this is where we've had a lot of pushback we get from client CFOs, controllers, saying that, we can't take such a big hit in a P&L. This was always structured as a part of a payout. So, this is something that you can always tell, your clients to be mindful of when they are wording their contingent considerations. And the accounting standard is pretty clear and straightforward, because they mention that, when you're linking a payment to an employee continuing the business, it is essentially for the benefit of the post-acquisition entity and not the pre-acquisition entity. So, if you read Ind AS 103, it clearly says that any kind of expenses which benefit the post-transaction entity is always a profit and loss item. This just lists down, what are indications or how do you decide whether it's compensation or a consideration. I kind of summed up what this says. Here's an example, as I was saying. So you can just probably take a minute to read through this. Yeah, so here the initial payout of $800,000 is pure cash. So obviously it forms a part of consideration. The scenario one where the additional payment requires a particular threshold to be breached for the revenue, and also requires him to be a part of the company. Would that classify as consideration or compensation? And second scenario, when it's only to do with the performance, what would that be, consideration or compensation?
First one would, I guess, be compensation.
Yeah. Perfect. And the second one is consideration, because it has nothing to do with the person kind of continuing with the business. Okay. Again, stressing on the importance of the valuation of contingent consideration, it is very, very important because think about a scenario where, we land up not applying the right approach or a method to value it. Say that, your method led to the fair valuation of contingent consideration to be much lesser than what I ended up paying. So, in essentially, it means that the company is done very well compared to what we estimated at the time of recognition of the contingent consideration. However, because my contingent consideration recorded is lower than what I have to actually pay, the difference is recorded as a loss in your income statement. So, it's very counterintuitive. Similarly, if I had overvalued my contingent consideration and I'll end up paying a lower amount because the company didn't perform as well as I thought it would, right? That will end up you booking a gain in your income statement. So it kind of looks very odd. Now, how do we value or fair value a contingent consideration? So there are two methods. Essentially, one is a PWOM, which is nothing but a probability weighted average method. Now, not an ideal method, especially when it comes to any kind of consideration, which is a financial consideration. If it's maybe getting any approvals, say for example, you're a pharma company, you're talking about getting any ANDA approvals or FDA approvals, or the condition is only about the company getting listed in an X period of time. Maybe there you can look at a PWOM, which is extremely subjective. But if it's any kind of revenue targets, EBITDA targets, revenue growth rates, any financial parameters, it's always advisable to look at an option pricing model. And most likely, you will have to land up using a Monte Carlo against a Black-Scholes or a binomial, because those kind of have very limited parameters. A Monte Carlo simulation kind of takes into account a lot of factors. What's the expected growth rate, what has been the past or performance of the company, what direction can those parameters go, negative, positive. So that's a more comprehensive method to consider when you're looking at Monte Carlo. And as and when we see these acquisitions happen, especially these early stage companies, whenever they get acquired, a lot of consideration is kind of paid as earnouts or contingent considerations. So it's really important for us to understand the valuation of such items. Another part of the purchase consideration that we need to be mindful of, any kind of consideration that has been transferred for the purpose of, or rather any expenses that you've incurred as acquisition related costs. They are not supposed to be a part of your purchase consideration. They will be expensed in your post transaction P&L account. So going back to the non-controlling interest part, the non-controlling interest also is required to be fair valued. Now, not fair value, they need to be recognized in your post combination balance sheet. There are two options that can be applied. Now it's purely at the option of the valuer and the management, obviously. One is you can fair value the non-controlling interest. How do you fair value it? You actually do a business valuation, or you already have a transaction price, which essentially is a fair value, and then you apply certain discounts and get to a fair value of the non-controlling interest. In that scenario, your purchase price allocation exercise will essentially show the 100% value of the company as the purchase consideration, and you will value all the assets and liabilities as if you own 100% of those. Option two is we look at only the non-controlling interest. So wherein what we'll do is the purchase consideration will exclude the valuation of the minority interest, and all the assets and the liabilities that you are fair valuing, which form a part of the balance sheet, will only be recorded at the proportionate share which we have acquired. And obviously, the goodwill amount will vary between the two.
I just had a question.
Yeah.
So related to this fair value of the non-controlling interest, if we value it at a fair value, so do we have to apply any discount because we would be having a majority stake for non-controlling interest holders stake, minority stake, do we have to apply any discount?
Yes, you need to. So it depends, Sagar, how you're valuing it. Most likely what you will do is you will say it's a transaction that has happened between two related parties where A is buying B. Let's say I'm buying 60% for 60 crores, right?
Okay.
You essentially have a control value there of 100 crore of the entire entity. And you correctly said, because I'm trying to value a minority, I need to apply those discounts.
Okay.
On there. However, in a scenario where you are actually doing a valuation exercise, you're looking maybe at a market approach to determine the fair value of the entire company, then maybe because that market approach will eventually give you a minority value, you may not need to. But in all practical purposes, you will always look at the transaction price and then apply those discounts and come to the fair value of non-controlling interest.
Thank you.
Right. Okay. Also, the other portion of purchase consideration that you need to consider is there can be scenarios where there are step acquisitions. That means that on day one, A bought 5% of B. Next year, it bought another 15% of B. So you keep buying those, let's say every year. Eventually, you will reach a stage where you are acquiring more than 50%. So the date on which you actually acquire the stake that gets you control, all the prior acquisitions that you made need to be fair valued and added to the cost of acquisition. And any change in the fair value between what you bought and the value as on the date of control will be recorded in the profit and loss account. Right. So we spoke about consideration transferred, fair value of non-controlling interest, and acquisition date fair value of previously held in equity interest, right? Next is basically the valuation of intangible assets and assumed liabilities. We'll get to that. However, the addition of what you paid plus the non-controlling interest value plus the true-up value minus what I've got is essentially goodwill or a bargain purchase. Now, if it's goodwill, very straightforward. It gets recorded as an asset. I'm sure we are all aware it is not to be tested, or it is not something that's amortized. It is subject to an annual impairment test. And goodwill essentially, represents any kind of future economic benefits that the business is expected to generate, which you've not been able to, separately allocate to certain tangible or intangible assets. It gets a little tricky when it comes to bargain purchase. One, bargain purchases are very unlikely. I mean, obviously there can be. But there needs to be very clear evidence that kind of supports an existence of a bargain purchase. Even if there's enough evidence, we need to ensure that you're rereading, relooking to make sure you're not missed anything before you conclude that there's actually a bargain purchase. And any bargain purchase is to be recorded as earnings. Now, when I say reassess and review or relook at, whether you missed something, is what you need to look at is one, make sure you correctly identified all the assets that I've acquired. We've not kind of considered some asset which ideally did not form a part of the acquisition, or you ensure that all the liabilities that has been assumed have been taken care of. You've not missed certain liabilities. Ensure that non-controlling interest has been considered in the purchase consideration. Any kind of previously held equity interest is fair valued, and your consideration transferred includes everything that forms a part of the acquisition. I'm just going back to the assets acquired. This is something that you've seen a lot of valuers miss as auditors. So what happens, bargain purchases are generally very common when you're looking at distressed sales, right? And they'll end up being a little bummed up because maybe the fair value of a plant and machinery kind of goes up, because of which your PC becomes much lower than the assets. Now, what can happen is, while there can be genuine cases of a value of plant and machinery actually increasing and leading to a bargain purchase, but there's one check we need to do, which is the concept of an economic obsolescence. What that means is, there can be times that there is let's say a particular machine lying in your factory, right? And if you go hire a plant and machinery valuer, he'll look at the economic life of the asset, how much is that machine being sold at, what was the cost price, and all of those parameters, and give you a value. So say for example, the book value was 20 and the fair value comes to about 100. Putting that 100 will essentially mean that say for example, is leading to a bargain purchase. What you need to be careful that is, while that machinery's price might be 100, okay, if you need to go to buy that, but that machinery is not able to generate any economic benefits. So example sake, it kind of produces, let's say, plastic bags, right? And in a time where plastic bags were banned, while that machine is in perfectly good condition, there's no way it's going to be able to generate economic benefits, right? So that's what you need to check, that whether that machine's fair value is substantiated with its capacity to generate any economic benefits. How do you substantiate that? Do a simple income-based valuation for that asset and see if the value using those income-based approaches is lower than the price that you've got from a tangible asset value, or that's a case of an economic obsolescence, and you need to kind of record it post adjusting for that. This is how essentially a PPA would look like. Basically there'll be a purchase consideration. You will identify tangible assets, intangible assets, and the net amount will be goodwill. Do you guys want to take a quick shot at this in just another illustration? You want to have a look and let me know what the final amount of goodwill would be. Right, it's 42 million. So 100 million of cash. 15 million is acquisition related expenses, which do not form a part of your PC. 6 million was supposed to be paid if post combination revenues are more than 200 million, and the fair value of that was said to be 2 million. So 100 plus 2 becomes the purchase consideration. And assets were 70. Identifiable intangible assets were 25, and 35 were the liability. So that's 60. So 102 minus 60 is 42. Great. Okay. Yes, and in case it's a transaction between entities in the common control, as I said before, Ind AS 103 does not apply. We do not need to do a PPA. In that case, you will do a simple pooling of interest method where you will just add across the assets and the liabilities of those entities at book value and add them across. In terms of disclosure requirements, every time there is a purchase, there is an acquisition, and we've done a PP exercise. At the end of the reporting period, we need to give the name, description of the acquiree, acquisition date, percentage of voting interest required. So it says voting, right? It does not really say percentage of stake acquired, because it's the influence that I have on the company. Then acquisition fair value of the consideration transferred, and goodwill, which can be deducted for tax purposes. If at all, there are several transactions that have happened in the year, and which by itself or individually they are very, very immaterial. you may want to just club information for those transactions and present it as one. So moving on to the next part, which is basically intangible assets, right? Which is the crux of a purchase by the allocation exercise. These are basic definitions. I'm just going to move on from there and talk about more concepts related to intangible assets. Now, there can be several intangible assets which get acquired or you can identify whenever there is a transaction. Now, however, from those, which are the intangible assets which can actually be recognized for a PPA exercise, they have to either meet one of the criteria, separable or contractual. So they have to be capable of being separated or divided, transferred or licensed or rented or exchanged, or they need to be contractual. That means that I have legal ownership of that asset. In the first case, when it's separable, the intention of the buyer does not dictate whether it's separable or not. It's supposed to be validated on a standalone basis. And in any assets which do not qualify for the separability criteria or a contractual legal criteria are basically from a part of goodwill. Okay. Examples of separable and intangible assets will fulfill the criteria of it being separable can be technology, patents, databases, contractual can be customer contracts, leasehold agreements, or copyrights. Customer relationships are separable simply because you can always pass on a set of customers to your acquirer, right? So it doesn't need to be contractual. It's a relationship I have. And most of the times, customers will move to the acquirer in that case. So it's very common. In fact, it's one of the most commonly recognized intangibles in a customer relationship. You can use this flowchart to identify whether a particular asset can be identified and valued. Does it meet the contractual criteria? If it's yes, recognize separate intangible asset. If it's no, check whether it's separable. If it's yes, you need to do one more check. While it can be separately sold or rented or shared, is there a restriction on the transfer of assets? For example, if you have a database of people's medical records, right? While yes, it's separate an asset which you can easily sell, but are you allowed to sell those assets to somebody by itself? It's no, obviously, because those are confidential data. Then if there's a restriction, it is not it's not a separate intangible asset. If there are no such restrictions, then it can be recognized as a separate intangible asset. This is just a list of different kind of intangible assets which you will commonly see. Okay. Now, when it comes to valuation of intangible assets, there are three basic approaches, very similar to those that we use for valuing a business. Market approach, income approach, cost approach. Market approach is essentially, again, you look at transactions of intangible assets which are available in the public domain. Very, very challenging, not commonly used because you'll hardly see any transaction will talk about how much amount was paid for a particular intangible asset, right? You'll see PPA reports, but those are more of allocation exercises and you can't really apply any multiples there. So not commonly used. Income approach and cost approach. First, I'll talk about the cost approach. Very straightforward. Any kind of cost estimate that you use to kind of value an asset. Again, any asset which has cash generating capacity should ideally not be valued using a cost approach because the cost approach will not take into account the future earning capacity of an asset. So left with an income approach. Income approach essentially is somewhat similar to a discounted cash flow method, but there are variations to it. The most important one being multi-period excess earning method, then the relief from royalty, and then without the method. So again, income approach. Under the income approach, value is determined based on the present value of cash flows, cost savings, or income attributable to a subject intangible over the economic useful life. The income approach under or rather valuing an intangible asset is a little, as I said, little different because when you're valuing a company, you're basically all the cash flows that the company is generating need to be considered to value that company, right? However, when you're valuing an intangible asset, the cash flows that a company generates are because of several other assets apart from that particular intangible, right? So, for example, if you're valuing a customer relationship, now your customers definitely are contributing to what you're earning. However, there are several other factors at play. For example, the working capital that you've used, the capex that you've used, certain intangibles like the brand name also contributes to you generating revenue. There can be a technology that you're using to generate that revenue. So, all of those kind of contribute to you generating that cash flow. As a result, to value a customer relationship, you need to isolate those cash flows as well. And it's the most commonly used income approaches are one of the most commonly used methods to use to value intangible assets. You'll most likely see a customer relationship, customer contract, technology, trademarks, non-compete agreements, any kind of relationships you have with your vendors or your will also be valued using an income approach. Now, so an income approach, again, as I said, most commonly used, and it's always used to value your primary intangible asset. Now, what's the primary intangible asset? It is the asset which was the driver of the acquisition. So, sit with the management, talk to them, what was the primary reason or why the company was bought. Obviously, there'll be certain tangible assets that they have, but there'll also be certain intangible which kind of made the transaction happen. Again, sources for getting that information can be management, look at due diligence report, look at companies, which have been in similar transactions, what have they considered as their primary intangibles. Now, once you identified your intangible asset, 90% of the time, it will either be a customer related asset or either be a technology related asset. Even in customer, it will not only be customer contracts, it'll also be a customer relationship, and they are generally clubbed together when you're doing a valuation for a PPA. So what are the cash flows from customers that I should consider when I'm valuing a customer related assets, right? So I will look at only cash flows which are generated by existing customers. Now, in a scenario where it's an IT company, however, I say we concluded that the relationship is more important than the technology. That would mean the relationship is a primary intangible. And while technology exists, it's not really the primary transaction driver. So in that case, you will take, so essentially that means that revenue gets generated by certain technology that the company has, right? So in that case, you'll take cash flows or rather revenues that are generated from the customers which are existing at the transaction date by using the existing technology as well as the future technology that gets developed. However, if technology is your primary intangible, in that case, you will take revenue only generated by that particular version of the technology, either by selling to existing customers or even selling to newer customers. So you need to ensure that you are getting this distinction correct. If it's a customer related asset, take revenues generated only and only from existing customers. If it's a technology assets, revenue only and only from existing version of the technology. The next part is the discount rate. So calculation of the appropriate discount rate requires some additional considerations here for intangible assets. One is the discount rate should be determined considering a market participant assumption. We come to this. Both IRR and WACC are to be considered when selecting discount rates. And your discount rate should be aligned with the risk commensurate with the individual assets, intangible assets, individual cash flows. So, I missed this question. When I'm on an approved vendor list, which is typical to get any, like defense can be argued. Yeah, even if you're on a vendor list, Sagar, your company, right, is on a vendor list for a particular customer, you can, right, if you sell your company to another acquirer, your customer contracts will ideally kind of put that will have that clause in case of a change in control. We'll either renegotiate or the business continues as usual. So it is still separable in that case, unless there are very specific restrictions that you have in your customer contracts, or rather when customer contracts where it says that in case of a change of control, we need to renegotiate terms or something like that, which ideally will be flagged off when you look at the financial due diligence report. Right. On discount rates, I'm sure we all agree that the business as a whole is relatively less riskier than individual assets, especially the intangible assets that we are looking at. So your intangible assets discount rate will ideally be a little higher than what your basic discount rate would be. And again, the delta would vary upon the type of intangible. So any kind of contractual assets that you have in terms of patents, backlogs, customer contracts, they will be less riskier relative to relationship, customer relationship, any kind of know-how, any kind of IP R&D or goodwill, which will be the most risky compared to that of the business. Now, since you're using an income approach, it's also essentially to understand, what is the essential economic life, or in valuers term, till what year should I extend my cash flows, right? One, it can be indefinite. Indefinite can be only, or it can only be a case where the asset has been existing since a very long time. It enjoys a great recognition in the market if it's a trade name. So for example, Coca-Cola, right? If that has to be sold, obviously the brand name Coca-Cola is going to be an indefinite asset. Also, if it's some customer relationship that you're talking about, if in the past the customer attrition is very, very low, we've seen cases where clients have not lost any customers over the last 5 years. That essentially shows that what a great relation that company has with the customers, which can warrant an indefinite life as well. However, in other cases, there are a few norms which can be followed to identify what the right economic life could be. It can be based on entities' historical experience, expected use of the assets, if there's any contractual life attached. So even if it's an IP, it might have a contractual life attached to it. Also, in terms of best practices, what you can do is you talk to the management to get all of those information that I spoke about. You look at comparable companies where they've made acquisition of similar companies. What have been the lives of the intangible assets there? Also, there are ways in which you keep extending your cash flows up to a level at which every addition year, the value that is added by extending by every additional year is less than 5% or 2%, which kind of makes that addition number very immaterial, or any specific market conditions, which is available out there, which tells us that a particular asset will not be worth for after 5 to 6 years, for example. So as I was saying, so customer relationship, it's rare to have an indefinite life due to the frequency of customer turnover. And generally, in this illustration here, we keep extending up till the time, like in the year 7, the 134, the additional increment is basically less than 5% of the total value of the asset. And, that's where we say, okay, 7 years is what we believe is an economic life. However, again, one thing we need to be mindful of, economic life is different from accounting life. You as a valuer can call it 7 years. The management is free to kind of use an accounting life which it has in their policy. It gets very, very challenging with the auditors, but GAAP does allow you to do that. The next one is tax amortization benefit. Maybe not very relevant for if you're valuing companies domiciled in India. However, if at all any other region you're looking at, and if that region allows for any tax amortization on any intangible assets, you need to consider the value of such tax savings when you're valuing the intangible asset. was all associated with the income approach. Market approach, value is determined using market data, involve identical or similar assets. Likelihood of that data is remote, as I said earlier. Guideline transaction is the most commonly used method. Where can you get data if at all you had to find them? Can be in companies' filings, some court rulings, or if there has been any intellectual property auctions. What are typical assets that you value using a market approach? Domain names, trade names, technology. Now you see a lot of practitioners using a royalty relief from royalty method for valuing, say, trade names or technology, and they kind of classify that as a market approach, which is a gray area, obviously, because the royalty rates that we are looking at, you get it from the marketplace, but you're applying them on a cash flow. So yeah, it can either be classified as a market or an income-based approach. Last is the cost-based approach. A cost-based approach is used for valuing assets which currently are not able to determine the expected cash flows from, and those assets which can easily be recreated within a reasonable amount of time. Typically, you look at any kind of technology, which is being used in-house, which is not generating separate cash flows for you, or if there is any in-process R&D which has not yet reached the stage where you are able to see the economic feasibility of it, which obviously, as per accounting standard, when you are incurring those costs, you're not allowed to capitalize, but when you're doing a transaction, in-process R&D is allowed to be bought on the books at fair value. Now there are two methods under the cost approach: reproduction cost, replacement cost. Reproduction cost is essentially creating an exact duplica or replica of the same intangible asset using the exact same inputs that had gone to create that asset using current prices, and any kind of obsolescence or inadequacies that need to be applied to that has to be applied to that value. Replacement cost is basically to estimate to create the similar asset with equivalent utility. Doesn't need to be identical, something similar, modern materials, modern design standards, layout. You use those costs and determine what the fair value would be. Any kind of curable inadequacies, that means that if there are any flaws in the existing intangible, you can obviously, because it's a replacement cost method, you can fix that and that gets added to the value. And it's extremely subjective, because you're going to talk to 5 different people from 5 different departments in an organization, get their estimate on how long would you think it would take to recreate this if it had to be recreated, talk to the finance guy to understand what would the cost be. So it can get extremely subjective. Okay. One of the most important aspects of a PPA over here, what kind of sets it apart from any basic valuation is the definition that it needs to follow, fair value, right? Which is essentially the price that would be received to sell an asset or pay to transfer a liability, an orderly transaction between market participant at a measurement date. It talks about orderly transaction, obviously it cannot be a forced or a distress sale, and it has to be between market participants. Now, what is market participant? This gets very, very critical to understand and apply when you're doing a valuation. It needs to assume when you're doing a purchase price allocation, or rather any valuation under Ind AS, be it Ind AS 103, Ind AS or IAS 36, where you're talking about impairment testing, right? All of them send you to Ind AS 113 for the framework of fair valuation. And there it says that you need to ensure that process is followed, taking assumptions which a market participant would take. So for example, your A is buying B, right? And company A has a capital structure of 50% debt, 50% equity. Whereas most of the other comparable companies, which could have been a candidate to acquire B, has a much lower debt to capital ratio. In that case, when you're building up discount rates, you will not look at what A has, you will look at what the market participant has. Similarly, if you're looking at another example, could be assets, a particular asset, right? So, I've listed one down. So company A is acquired and has a trade name that was used previously. Now the buyer intends to discontinue the name in the near future. This is a classic example of when Coca-Cola bought Thumbs Up when they entered India. Thumbs Up was never meant to be continued. It was always going to be closed down, and the Coca-Cola brand was supposed to be used. So at that point in time, if you had not applied a market participant assumption, the brand value thumbs up would have not had any value. You wouldn't assign any value to thumbs up. However, that's not the case when you're doing a PPA, because it says that if not Coca-Cola and somebody else, some other market participant would have acquired thumbs up, they obviously would have continued the use of that trade name. So here, as we see, further analysis suggests that other strategic buyers would, okay, this is the other one. The other strategic buyers would also discontinue the trade names. In that case, the trade name with the assumption of discontinuation would be appropriate. However, if the evidence would have shown that other buyers would have continued the trade name, then you would actually value that trade name. Another option can be a pharmaceutical manufacturer acquires a firm with a portfolio of FDA approved products. One of the products competes directly with the existing product of the acquirer, and the acquirer does not intend to use this product. Obviously, they would not. It would cannibalize their product. Analysis indicate that the buyer and the target are the only firms with the products in the category. This would suggest that there's no other player who would have actually been able to who actually has this product in the market. Any other market participant would have gladly continued using the product which the buyer wanted to discontinue. So in such a case, you will recognize and fair value the product which ideally was to have discontinued. Another concept that we have for when it comes to fair valuation is highest and best use. This applies. It essentially says that you value the asset in a manner which will generate the highest economic benefit to any market participant. Obviously, those use should be physically be possible, legally permissible, and it should be feasible as well. By default, the existing use of an asset is assumed to be highest and best use unless you have anything that contrary. An example here could be, let's say a large multinational company has a big piece of land, spare space lying in their corporate office, example, right? And they're using it as a gallery to showcase, all of their discontinued products. Now, it's a choice that company's made, right? However, if that of property was to be leased out, and if it was legally possible and feasible, it would have obviously generated some higher cash flows than it is currently. In that case, when you're doing a PP exercise, you will actually assume that piece of land was actually leased out and add that to the value of the property. Another important tool for a purchase price allocation is the IRR. Basically, IRR is the internal rate of return analysis. Now, this is where this is how we actually start doing a PP exercise. What you'll do is you'll get a set of PFIs or projected financial information or forecast or projections, whatever you call it, from a client, which then kind of flows into as cash flows to value other intangible assets that you're looking at. Now, as we require market participant assumption, you need to ensure that the cash flows that you get from the client do not include any specific synergies that exist to the buyer. So, if A is buying B, A might have a very specific product which is really going to help B increase its sale. Now, if that product A is very specific to the company A, to the buyer, then any incremental cash flows of the target should not be included in the cash flows. You can only take the cash flows which have synergies which any market participant would enjoy. So you need to ensure you tell the management there are no buyer-specific synergies in your PFIs. Now, why and how? Why? And this IRR is a very important tool again, because what you'll do is when you get the PFIs from the management, you'll filter out any kind of synergies or entity-specific synergies, and kind of determine what the IRR of the transaction for the management was. Right? You look at the cash flows. You'll plug in you'll come to the PC and you'll plug in what was the discount rate, the discount rate for the transaction that the management may have kind of computed. Now, let's say you get 15%. Going back, everything under the framework of India's 103 has to be market participant. So even the discount rate that you build up for valuing or intangible assets, that need to be market participant. Now, how do you ensure your cash flows and your discount rate of market participant. If when you compute your discount rate, if that number lands up tying up with your IRR and the IRR has to be based on a market participant assumption again, that means that your cash flows and your discount rate, they are both market participant and they'll fit well in the model that you're trying to make. So if at all, your IRR is greater than your discount rate, which means that the cash flows that you've got, they are either very, very optimistic, because of which you need to go back to your discount rate and add an alpha or a company specific risk premium to ensure that you're putting in certain risks to take care of the uncertainty of those cash flows. Or it means that there are certain entity specific synergies which the market by itself is not able to comprehend, because your WACC will build up using market based inputs. So if those kind of returns are not expected by the market, that means any market participant does not have those kind of cash flows expectations. On the other side, if your IRR is lesser than the WACC or the WACC is higher, that means that your PFIs might be good. They exclude any synergies. However, maybe they have been made very conservatively, or you kind of paid much more than what the fair value of the acquirer is. So whenever you see these red flags, you need to go back. You need to have a talk with the management, making sure that you ticked all the box on what is required. But this IRR and the WACC reconciliation is something very, very essential. And most of the times, if it does not tie up, then there is something missing. The next check you want to do, just to make sure that once your PP exercise is over, you fair valued all the assets, liabilities, intangible assets, and come to a value of goodwill. You want to ensure that those values that you got are making sense. For that, there's another analysis that is done, which is known as the VARA analysis, which essentially means weighted average return analysis. Here, what you do is you have the fair value of all the assets. So, for example, net working capital assets and goodwill and other intangible assets. In this column that you see here, after tax required return, this is essentially what is an expected return from these assets. So obviously, when it's working capital, your expected return from a working capital will be pretty close to your post-tax cost of debt. Fixed asset also will be pretty close to your post-tax cost of debt. And goodwill and other intangible will ideally be the balancing figure. And what this means is, it's kind of the required rate of return corresponds to the risk of each of these assets. So if you go down, where we've broken down the goodwill of 20,631 into all the intangibles, you will see that eventually the balancing figure that you get of a residual goodwill, right, which is 19.61, which is basically the return you expect from a goodwill. And goodwill being the most risky of the assets, it will always require the highest return, which is very evident from here. So when you see that your 18.98, which is equal to my WACC and my IRR, is leading to a residual goodwill after tax required rate of return, which is higher than the return of any other asset, it kind of says that, yes, the analysis is kind of making sense. Intuitively, it looks okay. We've not kind of missed any intangible, or we've not overestimated the discount rates or underestimated the discount rate for the other assets. The WACC, VARA, and IRR analysis or reconciliation is something which is very critical. Any auditor, when they first get a PPA, will open up and look at this. And if this ties up, it kind of it gives the comfort that, okay, what, at least conceptually things are making sense. Let's look at every assumption and every number if there is anything wrong there. One point that we spoke about earlier was, I think we didn't discuss too much about workforce. So now assemble a workforce, while it's a very important intangible asset, no doubt. However, accounting standard does not permit recognizing the same on your balance sheet because it does not essentially meet the contractual or separable criteria. So why not contractual? One may argue you have contracts with your workforce, or your employees. However, those are with individual employees. You do not have any contract with a group of employees where you have certain restrictions on them as a group. Again, similarly, separable, yes, you can pay two employees, send them to some other organization. It's not going to affect you too much. However, think about uprooting an entire workforce and selling it to somebody else. Your own operations are obviously going to suffer if the entire workforce go at a time. So you can't really separate the entire group as a whole. Because of these two reasons, does not fulfill the separable and contractual criteria, and thus it is not recognized as an intangible asset. But then why does it need to be fair valued, right? So if you guys if you've been aware of the multi-period excess earning method, which is used for valuing an intangible, and I spoke about briefly earlier, where you're trying to isolate cash flows only to the asset being valued. That means taking out values of all the other intangibles, and an assembled workforce forms a very important part or plays a very important role in you being able to generate the cash flow. So, to be able to derive the value of other intangible assets, you need to determine the value of the assembled workforce to be able to remove that value from there. I have another Q&A. I'm not sure, if you want to kind of just have a look at this. I don't know how we'll do that online. These are the methods you would use and why. Okay, I think that's all I had. Open to any questions that anybody has.
Yeah, Anand, thank you so much. I think it was a very interacting one. So I think in terms of question, anything more on tangible asset side? So intangible, I think you've covered very deeply and with all methods, including of adjustment of VARA, etc. So in terms of
Yeah, can we speak or we need to only post on the chat?
you can speak. You can speak. So in terms of tangible asset, do
Can't
you
hear.
find any? Am I audible?
I can hear you, Nishna. Raghu, I could hear you as well.
Okay, yeah, right. Yeah. So Anand, my question was on tangible asset. So, do you find any specific adjustments in your understanding where you have come across any practical cases for even valuing in some exceptional cases on tangible assets?
So we've not valued. I don't know. Can everybody else hear us? I think Raghu can't hear us.
Yeah, I can hear Anand and Nishant
Okay.
and Raghu as well.
Yeah, I can hear now. Thank you.
Perfect. Nishant, so we've not valued tangible assets. I mean, we can't, right? We are accountants and you need to be engineers and stuff. But I did briefly, spoke about an adjustment on economic obsolescence that you need to do on tangible assets, right? So while we can't price them, maybe you can have a check on whether the amount that is being provided by the tangible asset valuer makes sense by simply looking at, if they've applied an income-based approach, great. If they've not, you can attempt to do that. But it kind of becomes an onus for a financial and asset valuer only in the case where there is a bargain purchase. Otherwise, generally, if you're relying on the work of an expert who's a tangible asset valuer, at the most, you'll probably look at certain assumptions and try making sense of it. But in my experience, I've never been able to review it thoroughly because there are a lot of other conceptual knowledge that you need to have, which at least as accountants, I don't think we have.
Okay. Better to rely on experts. Certificate is the best option, I think.
Yes.
The better.
Anand, I have a question. I hope you can hear me.
Yes.
Typically, in your experience, these intangible assets, what is the discounting rate differential between the WACC and the intangible assets? It's like 1 or 2% higher,
Yeah.
or maybe
We generally put
7%.
1%, Raghu.
That's it. Okay.
It's very subjective again. But as I said, Raghu, what happens is the VARA analysis kind of makes everything fall in place because we've seen several. There are times we get a lot of valuations from other valuers and we don't agree on a lot of things, but their VARA ties up. So whatever they go and change, end of the day, if I make things right and the VARA still ties, the values don't really end up changing, right? So if your VARA, IRR, WACC are tying, most likely your values are right. Maybe they've done something wrong in concepts, but yeah, it just kind of makes sense.
Understood. Another point you mentioned was the difference between accounting life and economic life. In your experience, does that happen commonly? I thought they were probably the same thing.
No, it does. So if it's lesser, it's very often. So say, for example, a company is very, very acquisitive, right? And they have an accounting policy of depreciating or amortization a customer relationship over 10 years. And my economic life says 15 years. They've very well gone ahead with 10 years, while, as I said, auditors do come back, but the gap is very, very clear that it can be different. And it's possible, right? Today, in terms of cash flows, an asset, it's just like a tangible asset, right? A tangible asset can generate cash flows for you for years, but if there's a policy that the company's adopted, which is in line with the Companies Act policy, why can't economic life and accounting life be different? But it's seldom seen, Raghu, but it exists. We've done that. Okay.
The third and the last question I had was this tax amortization benefit. Isn't it available in India? Because I can amortize all my intangibles.
Yes, for intangibles, yes. For intangibles, you're absolutely right. Yes. So you need to ensure that the tax benefit that you are getting, because you're able to amortize those, gets added to the value of the intangibles.
Yeah. Okay. Okay. Fine. Thank you.
Yeah, hi, Anand, I had a question. So when we are talking about the cost of WACC for valuing the intangible asset, what I understand is the majority of the times there would not be any debt available or any bank funding would not be available for acquisition of intangible asset, like trademark or something like that. Then drawing the analogy from that, is it possible that we have to use only equity for discounting?
No, so see, don't look at it on how much would I been able to debt could I raise just to acquire that asset, right? Think about it from a perspective of a person who's acquiring the asset, a company who's acquiring the asset. What would their cost of capital be, right? That's what you want to look at. So today, a company A is going and buying certain intangibles. They already have a capital structure in place, which they are going to kind of obviously maintain to go and fund that acquisition. So while on a standalone basis, if you go to acquire a debt, you're not going to be able to go to a bank and say, "Yaar, mujhe 100 crore ka debt lena, you give me 100 crores." That's not going to happen, right? But a company, when it wants to acquire a particular intangible, it'll obviously fund something from their internal sources, and there'll be a debt to it. So it's more of looking at a cap structure again of a market participant on what is the typical capital structure. So that's what you will use that when you're trying to build up your discounted, even for an intangible asset.
And see, when arriving at the cost of debt also, there are many theories running in the market. So there are different school of thoughts that what should be the rate of debt, that whether the company's actual cost of debt should be used, or whether the today's market rate of debt should be used. So what is the appropriate theory? That,
It's a marginal cost of debt for a market participant. So company's own cost of debt, no, unless it is at arm's length, which ideally, especially if you're looking at larger companies, they would be. But the best way to look at is the cost of debt of similar companies out there, which are market participant in a similar geography. So, for all of the cases, you can look at companies which are outside the same location, but at least when it comes to cost of debt, to ensure that your interest costs are fairly reflected, you will look at cost of debt of the comparable companies.
But even though the company has the long-term debt from the related party,
You can. Your company forms a part of the market participants. So if you have 6 companies, including yourself, you will put your own cost of debt as well. Your company itself is a market participant too, right? So why ignore it?
And related to the assembled workforce, that cannot be recognized as an asset.
No, it cannot. Unfortunately, no. Yeah.
Okay, I think any further questions? All right, so let us end the session over here then today. Anand, personally, thank you so much for being here and giving us insights on India's 103. So what I believe is PP was really a need of a day to understand, to learn, and you have actually shown the hidden gems of it. So apart from that, you've been able to very briefly cover up tangible, intangible in detail, and understanding the goodwill of the bargain power. So I mean, overall, it was a very good learning session and quite experiential for every one of us. So on behalf of WRC team and study group of Valuation, I sincerely thank you for being here and taking up this session for today's day. Thank you so much.
Thank you, Mr. Anand. Thanks, everyone.